Hello, everyone. Matt Clark, research analyst with Money and Markets here with your latest Bull and the Bear podcast. Now, before I get started, I do want to tell you that we talked about this before, and if you've read Money and Markets over the last couple of weeks, you've seen us kind of talk up this new trading strategy that Chief Investment Strategist Adam O'Dell's been talking about. And I want to let you know that there is an event coming up on January 12th at 1 o'clock Eastern that you want to listen to, because in it, Adam is going to tell you about the strategy and how he guarantees, and what leads him to this guarantee of the average of 100% winner every month for a year. So I probably didn't phrase that exactly correctly, but the idea is that there's going to be 12 winners in here of at least 100% over the course of a year. So an average of 100% gains every month on the average for a year, and probably even more than that. So go to theinvestingsecret.com. That's theinvestingsecret.com, and find out more about how you can sign up and take part in this event. Again, it's on January 12th at 1 o'clock. You want to get your seat now. It's very limited, so don't wait till the last minute, because you may not have a seat. So check it out right now. That's theinvestingsecret.com. Now, to jump into today's podcast, I'm bringing in Money Markets editor, Green Zone Fortunes co-editor Charles Sizemore, this is a sector that we're going to talk about today that has had a lot of hype. I mean, a ton of hype, at least until around March of 2020, when nobody got any hype except for the coronavirus. Investors, myself included, saw this particular sector really taking off and soaring, and companies that take part in this sector were just going to go up like gangbusters, and it was going to be huge. But then the corona crash happened, and investors shift gears. The sector slowed down. Millions of businesses closed. Even more people were forced to stay at home. So the brakes were pumped quite a bit. But I have to admit, I'm still bullish and have been bullish even through the coronavirus on this sector. And I think it's one that's already started to gain steam. And I'm talking about 5G. Now, 5G is one of those, it's not necessarily one of those easily defined sectors, because there's so many things involved. It's not just cell phone companies. It's not just cell tower companies. It's not just, it's a wide range. It's not just semiconductors. I know those are the hot ones to talk about, but there's a lot more to 5G than just who makes the right cell phone, who has the tower, and who makes the semiconductors that go in it. There's a lot more to it, because it's a very complicated process. But 5G is basically the cellular and wireless technology that's being rolled out across the country and around the world, really, that essentially, just to kind of put it in perspective for you, now if you have a 2-hour movie that you want to download, it will take you, 20, 30 minutes. With 5G technology, that will be reduced to maybe 1-2 minutes tops, if not faster. So it's going to make the speed of which we do things on the internet, on our phones, on our tablets, how we conduct business, it is going to revolutionize how we do that. And I've talked about that before. But the growth of this industry, I can point to the Defiance 5G Next Gen Connectivity ETF. It trades on the New York Stock Exchange under FIVG, that's 5G. And it's about 74% higher off of its March lows. Now, that's a little subjective, because, again, March lows, everyone hit a March low, and any gain you see off of those March lows is going to be pretty good. But this is actually very strong. 74% for this ETF is actually very impressive. So what I want to do today is I'm going to bring in Charles. And first off, Charles, thank you for joining us. Welcome back from your holiday sojourn to Peru. And we're going to talk about 3 companies. And Charles and I are going to give you our take on those 3 and let you know whether they are companies that maybe you should invest in, maybe you should put on a watch list, or ones you should probably stay away from altogether. So I want to get to the first one first. It's a company that produces equipment that are used in mobile devices, other wireless products such as network equipment, broadband gateway equipment, consumer electronic devices. This is just a very, very smart way of saying they make a lot of the equipment that are used for 5G implementation. That's about as simple as I can put it. The company has beat Wall Street expectations for both earnings per share and sales in each of the last 5 quarters. So it's had a very, very strong run. It had a very, very good 2020. One bit of news, however, most recently is that its CEO announced their retirement after 26 years with the company, but they've immediately ushered in a successor without much fanfare or anything like that. Actually, it's a company veteran. The stock price went from a low of about $59.86 in March to a high of $158.80 in early December. It's about a jump of about 165%. It's pared back slightly and is trading now, as we record this and talk about this, at around $152. And I think a lot of that is part of this recent tech sell-off, as sectors are starting to turn a little bit with the recent election, not only of Joseph R. Biden, but also the Georgia runoff results where Democrats have now taken control of the House, or the Senate rather. So now you're going to see a little bit of a sector rotation out of tech and into other things like energy and whatnot. We'll talk about that in a separate podcast. But anyway, this company is Qualcomm Incorporated, trades on the NASDAQ under QCOM. That's QCOM, QCOM. And Charles, first, let me throw it to you. Tell me your thoughts about Qualcomm.
Yeah, it's funny. I divide tech into what I would call glitzy, sexy tech, like the app of the day that people are talking about, software-based companies for the most part, right? Software and services companies. That's sexy tech.
Right.
Then there's what I would call gritty tech, which is just the stuff that under the hood, the equipment. The stuff that's not as interesting, not as sexy, and
the stuff you don't see the name of. Their names aren't stamped everywhere, so you don't. There's not an Apple sign or anything like that.
Like you don't really know who makes the carburetor. Actually, cars don't have carburetors anymore. What a ridiculously dated statement that was.
Right. I get you.
Who cares about the brand of a carburetor, right? It's under the hood, right?
Right.
So that's kind of where these tech companies are, right? It doesn't mean they're not important. They're just not as visible.
Right.
Well, I actually do like Qualcomm. I think it rates well. I think this is a stock that it makes sense to own for the next couple of years. Like you, I do agree that the 5G rollout would have probably been the biggest story of 2020 had the coronavirus pandemic not just turned everything upside down.
Right.
That did slow down some things because if you're a company just trying to survive right now, upgrading your systems to 5G may not really be top of the list.
Right.
Now, ironically, it probably should have been because with everybody working remotely and whatnot, it
would have been a huge benefit.
It would have been a huge benefit, of course. But, when you're just struggling to, think on the fly and just make your business viable during a revolutionary period, that's not going to be at the top of the list, right?
A lot of unknowns for businesses during the coronavirus, and it's nice to be aggressive. It's nice to be to think outside the box and figure out how you can work smarter, not harder. But I'm pretty sure that 5G wasn't really high on that priority list.
Not on the priority list.
It's not completely developed and rolled out yet.
Well,
contrary to what commercials will tell you, the 5G that you're getting, that you can see advertised from multiple cell phone carriers, isn't necessarily the 5G that you're going to see in the next year or so.
No.
In fact, it's not even close.
Not even close. Not even close. My cell phone will tell me I'm getting 5G signal, and I have noticed no material difference from my previous cell phone, which never had that. What does that tell you? It tells you it has not really been rolled out yet.
Exactly.
So, but yeah, Qualcomm should benefit from that trend as the world gets back to normal, and as companies start to prioritize more normal things, and as people go back to work. Remember, the unemployment rate is still very elevated right now. There are a lot of companies not investing in tech, because they're still slashing headcount. It's a bad look to be ramping up your R&D budget or your capital expenditure budget
and cutting employees.
But that goes into reverse this year. I mean, it already has gone into reverse. It's things are improving. It's a process, but the stock is on the right side of that process.
And I have to say that if you look at its fundamentals, return ons, its price ratios, all are very, very good, and they're very, very good when compared to the rest of the tech sector. In fact, another benefit of this company, it does pay a dividend. Its forward dividend yield now is about 1.7%, give or take. So you're looking,
which, by the way, is about in line with the S&P 500. So
exactly,
you are getting a market matching yield.
Exactly. If we take a look at Adam Odell's six-factor green zone rating system, Qualcomm actually ranks very high. It ranks in 86, which would put that in the strong bullish category for us. So we see it outperforming the rest of the market by at least 3 times over the next 12 months. It is a little pricey, not going to lie. Trading at around 152 is not necessarily for the average investor who may just want to look at a stock that's more $35. But when you've got a solid earnings per share, you have a solid dividend yield, you've got really good momentum going on right now, it might be worth bumping up and maybe getting a couple shares into Qualcomm. I like Qualcomm. I'm with Charles. I think we're both pretty bullish on Qualcomm, and it'd be a company definitely worth having in your portfolio. The next company, this is a company that develops products for mobile radio, macro radio, cloud native radio equipment. All these radio type technologies are used primarily in cell and mobile technology. It's met or beat Wall Street expectations for earnings per share in each of the last 5 quarters. However, kind of not a huge issue, but one to consider is that it does have a 1-year annual sales growth rate of negative 5.4%. Not horrible, but not great. However, on a bright front, it recently announced it was working with a Saudi Arabian company to implement 5G-powered Wi-Fi and 60,000 5G gateways across Saudi Arabia. So that is a huge rollout and implementation in a country that is challenging in terms of how to spread out 5G coverage, because you have a lot of very concentrated population right in the middle of a lot of desert. So it'd be interesting to see how they navigate. The company's stock price reached a low of about $2.42 back in March. Again, everyone hit a low back in March of 2020. It kind of goes without saying, but it did jump to a high of about $5.10 back in August, which is a 111% increase. The price has backed off a little bit. Again, probably due a little bit to the sector rotation out of tech, to about $4.08 per share as we're recording this now. The company is Nokia Corporation, trades on the New York Stock Exchange under NOK. There is also a very complicated way of saying Nokia, but we'll just keep it at Nokia because getting into the Scandinavian pronunciation just really, it's like Ericsson, just really isn't worth it. Just call it what it is. So Charles, Nokia, this is a company that's traded, if you look at the stock chart, man, it's traded kind of strange.
Yeah, so I was initially a little wishy-washy on Nokia. I'm actually gonna revise that and say I'm bullish. There's a couple reasons. A lot of it comes down to kind of big picture macro. There's only a very small handful of companies that do more or less what Nokia does. Ericsson and China's Huawei. That's basically it. I know like some techies out there will probably take me to task and tell me I'm wrong, but like
I think in terms of companies that can do it to scale and they can work with other countries, you've got Nokia, you got Ericsson, you have Huawei, and that's basically it,
right? And so about that, the Trump administration sort of had an on again, off again bromance with China. It was 1 minute we're best friends, we got a deal in sight, the next minute we're mortal enemies, and it was just, it wasn't real consistent. But over the course of 4 years, the policy sort of congealed more around. It started to congeal over the course of 4 years.
Right. And
the incoming administration is, I think, going to continue that. And you're going to see, during the Cold War, U.S. policy wasn't that different between Democrat and Republican administrations. Republicans were a little bit more hawkish, the Democrats a little less hawkish. But there was broad consensus on, okay, there is a threat in the Soviet Union.
Right.
And our policy is to contain that threat.
Right.
Hopefully without firing the bullet. But, if we have to, we have to. But like this is, it was very clear.
Right.
I think what we've witnessed over the last, and it's been building for a while, but particularly over the last 4 years, Americans and Europeans, we've all had this idea. We had these conflicting ideas of, well, we don't really like the Chinese government, but wow, look at the size of that market. I mean, we want to do business there.
Exactly.
Yeah. And I think what we're, the conclusions we've reached, and it was a long time to get here, but it was, okay, this is not really a regime we're comfortable with. I think we really are. I mean, it's cliche to say it, but I think we really are in, kind of the early stages still of Cold War 2.0.
Right.
And, if you remember, there were the big scandals with, Huawei equipment being used to spy.
Yeah, you had issues in Africa. You had issues in Africa where in some countries that Huawei technicians were being asked by government officials to use their technology to spy on others. And and then there's also the fear that because of Chinese law, Chinese law does stipulate that a Chinese company can be used for government use. And the fear is that because
that's
5G
exactly
is
what they're going to do.
yeah, and because 5G is so, I don't want to say intrusive because that's not really the right word, but 5G is one of those things that we're all going to touch on a little bit. It's going to impact all of us. So it makes things like data and personal information and whatnot very susceptible. So the fear here is that the Chinese government can say, look, Huawei, we know that you've rolled out 5G technology in country X, and we want to use the data that you can pull from country X's users and store that or use that for our own gain. And the U.S. government is like, no, we're not going to do that. So
yeah, I think what you're going to see is more countries are going to kind of, well, you're probably going to have two sets of countries: those that are more in line with China and are comfortable buying Chinese equipment, and I might add, the Chinese equipment is arguably better. I actually have a good friend in telecom who lives in Peru. He told me, man, we had to go Huawei because when something breaks at 3:00 in the morning, Huawei they'll fly in some guy from China if they have to, and he's going to be on a tower fixing it like within an hour.
Right.
So we call the Europeans and they'll get to it in 3 months. So,
right. So basically, what you're saying is Huawei has better customer service.
Well, I mean, sure, but be all that as it may. I do think you're going to see a lot of political pressure building. Nokia basically has a massive advantage in that you're going to have the strong arm of government nudging carrier after carrier to use their equipment, Ericsson's equipment, rather than Huawei. So I think Nokia is actually, or Nokia, I still pronounce it wrong, but it doesn't matter anyway. I think this stock is one that it's probably worth holding on to for the next few years.
And I agree. And just for those very reasons, because you are going to have those two sides of this 5G battle on the nation side, because nations are going to be rolling this out, not neighborhood by neighborhood, but we're talking about country by country. The Great Britain is looking at it. Obviously, Saudi Arabia is looking at this. The United States is doing this, and this is going to be done as countries, not as, okay, we're going to roll. Now, maybe here in the U.S., it'll be done by neighborhood. Like we're going to do it in Dallas. We're going to do it in Palm Beach. We're going to do it here. But by and large, European countries and even those in Asia are going to be looking at this. We want to roll this out as a nation. We want this to be out, and we flip a switch and it's on and everyone has access to it. And I actually like that approach. And Nokia is going to face some competition from their Scandinavian brethren at Ericsson. But I think you're going to see more collaboration than competition with Nokia and Ericsson. And I like that. And I think Nokia can benefit from it. Fundamentally, their return-ons are solid. The price ratios are good. The debt concerns me a little bit, right around $7.8 billion in debt right now. But, I can get past that. And for anyone who's in the back of their mind is thinking that the U.S. is actually going to buy into Nokia or Ericsson, just dispel that right now because it's probably not going to happen. I don't see Scandinavian governments allowing that. But regardless, I think Nokia is a buy. I think it's a buy and hold, or at least a buy and look into for the next probably 12 months. And if we look at our green zone rating system, Nokia rates a 69 out of 100, which means we're bullish on it. It's kind of mid-range in volatility, mid-range in momentum. It's very good in value, as like I said, with its price to sales, price to cash flow, price to book, price to earnings, all very, very good, especially compared to the rest of the industry. So Nokia is a buy. For me, it is a buy for Charles. Now, our last company we'll roll through very, very quickly. It's a company that specializes in developing products to convert analog signals into digital data and in reverse, taking digital data and making it analog signals. It also works on radio microwave signals. Again, another fancy way of saying this is all things that are crucial into 5G implementation. For the last 5 quarters, the company's beat Wall Street earnings per share expectations, but has fallen short in 2 of the last 5 quarters in sales. Its 1-year annual sales growth rate minus 6.4%. Not a huge concern. Its 1-year annual EPS growth rate is a minus 9.9, but right around 10%. Stock price hit a low of $80 per share back in March. Has risen to nearly $152 per share as of this week. That's a 90% increase. However, from June to November, the stock has traded relatively sideways, and it wasn't until kind of the middle of November when it started to pick up again. It is about 6% off of its mean price target set by 20 Wall Street analysts, so it still has a little bit of room to grow according to some Wall Street expectations. So the company here rather is Analog Devices Incorporated, trades on the NASDAQ under the ticker ADI. Charles, ADI, briefly, tell me your thoughts.
I'm less committed to this one. I think it is a very decent company. I'm not super comfortable with the valuation right now. This is one I would probably wait on. I would not chase this one higher.
The only thing that gets me to be encouraged by this stock is its momentum. And its momentum since November. Very rarely do you see stocks move upwards like this. Stocks very rarely move upwards like this. They can move down like this, sure, but very rarely do you see them move up. But we did see something kind of strange in November over a course of about 3, 4, 5 days. That's exactly what ADI did, as they moved up like this, and they've continued that upward trend ever since. Now, are they going to maintain it? I really don't know. As far as their price ratios, they're kind of in line with the industry. They're not as good as Nokia or and they're not as good, obviously, as Qualcomm, but they are kind of in line. Their return-ons are all positive, which is good. They do have a little less debt. They do pay a dividend. Their forward dividend yield is about 1.6%, which is a little higher than the S&P average. There's still something to bank on. I would be kind of with Charles here, and that is, I think it can be a buy. If you're comfortable jumping into it now, then I would probably get into it now. I don't know if I can see a pullback here if it meets resistance at 152, maybe it could be a good resistance point. I'm not really sure. But I also think it could be a wait and see. Again, I think ADI is a company worth investing in. I'm just not sure if the timing is right now. So Qualcomm and Nokia, we are both very, very solid on. As far as ADI, I think we're kind of neutral, maybe a neutral buy, if you will, neutral to bullish. So that's kind of our take on those three stocks. Again, tons of 5G stocks out there, tons of 5G ETFs out there. We're probably going to talk more about this topic as the months roll and we start seeing more roll out. Again, I do want to encourage you that if you are listening to this as a podcast, go to our YouTube channel, go to youtube.com, type in Money and Markets. You'll see the green bull and bear logo. Make sure you subscribe and then hit the notification bell and get notified each and every time we put out a new video. Also, if you're on the reverse, maybe you're watching a video, you want to listen to it on your smartphone or as a podcast, you can check us out. We're on Apple Podcasts, we're on iHeartRadio, Google Podcasts, Amazon, a wealth of podcast indicators out there. Make sure you check it out. But I would be remiss if I did not tell you to go to moneyandmarkets.com each and every day. You'll see writings from myself, from Charles, from Adam O'Dell, from Michael Carr. We contribute every day information that is meant to provide safe and sound investment advice for you. And sign up for our free e-letter. We put out an e-letter every day, Saturday to Sunday, and it is absolutely free. Just go to moneyandmarkets.com. Make sure you sign up, and you'll start getting that e-letter ASAP. We've got more on the way. We'll have more from Charles next week on the Bull and the Bear podcast. Certainly thank you for joining us. And until next time, everyone, this is Money and Markets Research Analyst and your host of the Bull and the Bear podcast, the Marijuana Market Update, and the week ahead, Matt Clark, wishing you all safe trading.